You may have heard about special trusts that legally allow you to avoid income taxes. But if that trust is really a sham, and the IRS can hit you with penalties that double or triple your original tax bill, possibly send you to prison. Let's break down exactly what those penalties look like and how to avoid them. Hi, I'm John Strohmeyer with Strohmeyer Law, where we help our clients leave no unfinished business. While I am a lawyer, I'm not your lawyer, so don't take the advice of some talking head on the internet. Remember to talk to your own advisor about your specific circumstances. Also, don't forget to like, comment, and subscribe. Now, today we're talking about penalties that the IRS can impose, both civil and criminal penalties, when taxpayers have crossed the line. This is going to fall under potential avoidable costs when it comes to our four horsemen of the estate planning apocalypse. Because when you step over that line, intentionally or not, the IRS won't just collect the taxes you owe. They're going to tack on potentially penalties that can bankrupt you, pursue potentially criminal charges that can ruin your reputation. So before you follow that tax advice that's just too good to be true, because you don't think you have to pay any taxes, well, let's think about what's on the other side of that. Promoters can pitch things like complex, irrevocable, non-grantor, spendthrift, discretionary trusts, or things like ecclesiastical trusts under 508c1a. These are some sort of silver bullets for avoiding income tax. Well, they're often paper trusts where the grantor, the trustee, and the beneficiary are all the same person. They then claim that the income can be directed to the trust and then expensed away or just written off as though it's trust corpus, which somehow magically makes it untaxable. Well, the management fees and distributions that conveniently avoid those taxes really don't amount to much. In probate, beneficiaries may discover these sham trusts after death, and then they're stuck with the fallout: audits, unpaid tax liabilities, and litigation over whether the assets are even still available. So let's talk first about the IRS's civil penalties. What can they impose? First, there's the failure to file penalty under Internal Revenue Code 6651A1. This is 5% per month up to 25% for unpaid taxes. If your return is more than 60 days late, then there's a minimum penalty of the lesser of $485 or 100% of the tax due. When you start putting this together, again, that's 5% per month. So 5% for the first month, then 10%, then 15, then 20, then 25. So at 5% per month, the failure to file penalty racks up pretty quickly. Unlike, for example, the failure to pay penalty under 6651A2. That's a pretty big difference. 5% per month until we get to 25% for the failure to file, and 0.5% per month for the failure to pay. That's a pretty big difference. And what's going on behind that? Well, because we have a voluntary system of tax payment, not that you voluntarily get to choose whether to pay or not, but you're the one preparing the return and sending it in, the IRS relies on you filing that return. So it's much more important that they know what is out there so that they can audit those returns and then make sure all the tax has been paid. The failure to pay is important, but it's penalized less because, well, they'll get the money eventually. And so they want to encourage filing if at the expense of paying. Another penalty, the accuracy-related penalties under 6662. The accuracy-related penalties can be a 20% penalty for underpayment due to negligence or disregard of the rules, substantial understatement of income tax, substantial valuation misstatements, or violations of the economic substance doctrine. Again, what they're looking for here is making sure that you're filing accurate returns, not just putting down a bunch of zeros and saying, I'm a free sovereign citizen, I voluntarily choose not to pay. That's not going to get you very far, and it never has. Next, there's the fraud penalty under 6663. Here, 75% of the portion of the underpayment that's attributable to fraud can be tacked on as another penalty. Finally, the trust fund recovery penalty under 6672. This typically applies to employment taxes, like the withholding you see on your paychecks. So most individuals won't see this in their potential range of penalties, but it is important in broader IRS enforcement. Now, those were just the civil penalties, just the things where they can charge you more. If we want to get really serious, we're going to start talking about our criminal penalties. You've crossed a much bigger line. Now, first, our felony tax evasion under Internal Revenue Code 7201. Here, you can face up to 5 years in prison and up to $100,000 fine for individuals, $500,000 for corporations, plus potential prosecution costs. Under 7203, you have the willful failure to file. This one's just a misdemeanor, but it can still wind you in prison for up to a year and a $25,000 fine if you've willfully failed to file a tax return. Next, under 72061, if you filed a false return, well, we're back in felony land where up to 3 years in prison, a $100,000 fine, and potentially prosecution cost. Finally, there's the conspiracy to defraud the U.S. under 18 U.S.C. Section 371. This is used by the Department of Justice in certain cases where, again, they think there's a conspiracy to defraud the U.S. This can wind you into prison for up to 5 years and additional penalties. So let's pull this together with an easy example. A family has set up a sham trust called the Legacy Family Trust. They direct $100,000 of business income into that trust. The trust is managed by the same person who earned the income. The trust then claims deductions for consulting fees, housing allowances, and then allocates everything that's left under 643B from trust income to trust corpus. That's not going to work, even though they think they've zeroed out their taxable income. As a result, they don't pay any income tax. Well, the IRS is going to audit this, disallow those deductions. They're then going to determine under Mercosian and subsequent cases that that trust is a sham that has no economic substance. First thing they're going to do is reattribute the $100,000 back to the original taxpayer. Now, at a tax rate of 37%, I'm going to be simple with the math and just say, here, $37,000 worth of tax. In reality, there is a ladder of tax rates, so it's not actually going to be $37,000 of tax on $100,000 of income. But we're just keeping it simple for now. So there's your first $37,000 worth of income that's going back to the IRS. Next, if we have a 20% accuracy related penalty, well, there's another $7,400. Then potentially a fraud penalty of 75%. So we've got $27,750 added to our total. If there's a failure to file at a maximum penalty of $25,000, or if there's a failure to file penalty with a maximum of 25%, that's another $9,250. If they failed to pay, which they probably did, and let's just assume they didn't wait so long, maybe only 2 years or 12% at 0.5% a month, well, that's $4,400. Their total civil exposure with fraud is going to be $78,000 or $78,190. If we assume no fraud, well, it's just going to be $58,090. So here, if fraud is found, the total can exceed double the original tax. If they had potential criminal exposure, well, there's, again, the potential for 5 years in prison, a $100,000 fine, criminal restitution, and possibly permanent damage to their reputation, and potentially the inability to hold license or act as a fiduciary in the future. So as we pull it all together, the IRS has a huge stack of penalties at its disposal. And guess what? They're going to stack on top of each other. But I didn't know isn't a defense if the IRS finds negligence or willful blindness. Thinking that this sounds too good to be true is usually a great warning sign for you. Sham trust can be a huge magnet for both civil and criminal enforcement. The dollar amount in these penalties can easily exceed the original tax you were trying to avoid, and that's before you may have criminal prosecution. So the IRS isn't playing games when it comes to abusive trusts and tax evasion. If you're working with a legitimate structure for trusts, asset protection, great. But if the trust has no economic substance and exists only to dodge taxes, you could be looking at huge civil penalties, criminal charges, and career-ending consequences. So if you're listening to this and thinking that the setup you have now may not be fully in compliance, this is the best time to go in and get the help you need with a second opinion, because you definitely want to go to the IRS before they find you. Generally, the options you have when you go in first are much better than if the IRS has found you. If you've seen things offered online, tell us about them down in the comments below. It's always interesting to hear what sort of structures are being marketed to avoid taxes at all costs. Thanks so much, and we'll see you next time.